Welcome, Cedric. I'm Anthony Harchaoui, PMML, commercial real estate broker, Vice-Président. Cedric Kessous, Bayview Partners, managing director and CEO, right?
Yes.
So today I'd like to talk about industrial real estate. We're at the Leasing conference right now. You just did a wonderful panel with my colleague Laurent Paquin, and it would be a pleasure to discuss more on that panel subject. So we'll start with leasing, and we'll go into financing and purchasing price and cap rates and all the juicy stuff right now.
Let's do it.
But first, maybe if you could just introduce yourself in a couple words, what you do, what your goal is, what your maybe overseeing vision in just a couple words.
Yeah, sure. So thanks for having me. This is awesome.
Yeah.
My name is Cedric Kessous. I am the founder of Bayview Partners. We're a private equity real estate fund. We buy and develop industrial real estate on and outside of the island of Montreal, principally within the province of Quebec. Big ambitions for the company. We started less than 2 years ago, but I think the objective is to grow to several hundred millions of assets under management. That'll take the time it takes, of course.
Right.
But very excited with the progress we've had to date in terms of the acquisitions we've done, in terms of the pipeline that we have, and what I'm expecting to be able to close on probably before the end of the year and even into early next year. So, and we've been working on some stuff together that I'm sure we'll get into.
Yeah.
That's a bit about me.
Great, awesome. So, why industrial real estate? How did it start, and what got you into industrial real estate rather than retail or office or other asset classes?
Well, the quick story is that, and I'll go a little bit back, is I'm a lawyer by trade, and I did my university at Université de Montréal. I did my Barreau du Québec and my articling at Dentons. And during my articling at Dentons, which is a 6-month process, I realized that I didn't want anything to do with law anymore. I didn't want to be a lawyer. And there was an individual at the law firm that linked me with somebody that was buying industrial real estate in the US. So as soon as my articling was done, I took a job working part-time, hourly with him.
In the US?
No, he was based out of Montreal. He was buying in the US,
I
but he was buying industrial real estate. And that was my moment to jump ship out of law and into anything except for law. It just so happened that I was jumping into industrial real estate almost at random. And what started as a very part-time, almost secretarial type of job turned into an analyst role where I got to learn about the industrial real estate market. And so when I started my own fund, it was a pretty natural extension given that I was very comfortable in industrial and given all the fundamentals in industrial to pursue that as a thesis for our fund.
Perfect. Yeah. Awesome. Well, that's a great story. Did you start, how many years ago was that you started your own first, first
So
fund?
we started the fund in November of 2021.
Okay.
Prior to starting the fund, I worked for this individual that was buying in the US. I worked with him for about 2.5 years, and I was at Ernst & Young in their real estate strategy department for another 2.5 years. So I'd say about 5 years of experience before I started the fund. Definitely felt like I was a bit in over my head, and probably still feel that way a lot of the days.
Pretty much, yeah. I think it's the same for everyone in this market, right? Feeling over your head. The market's changing all the time. You got to be, agile, on your toes, ready to pivot at any time, especially with the type of sellers we see out there. We see a lot of mom and pop shops, right? It's not all institutional sellers or with a law background such as yourself that speak our language, right? As professionals in the field. So how do you deal with that, and how do you, remain patient and be understanding of that? Given your background is so in law, I've seen you in transactions with the average mom and pop that have no idea what they're doing in industrial real estate, inherited properties, right? It's a classic situation. How do you deal with explaining that sitting at the table, and how do you do it so well?
Well, thank you. First of all, I think that, the best people to buy real estate from are individuals that are unsophisticated, that perhaps don't understand the future stabilized value of their assets, or simply aren't real estate professionals and want to get rid of assets that they perhaps inherited over the course of a couple of years. So I think just remaining patient is the only way to get a transaction done. You have to have a certain human side to yourself where there are moments to be aggressive and there are moments to be a little bit more level-headed in terms of your discussions with the vendor. If that's where your question's going, I just really feel like if you want to get a deal done, you have to show a little bit of transparency. You keep certain cards to your chest, but overall you have to show some transparency, and you have to be willing to sit down with the other party and perhaps even walk them through the transaction at time, especially if they are very unsophisticated.
Right.
And, you know, we went through that on a property that we purchased where the vendors were not sophisticated real estate parties, and it took several sit-down sessions to negotiate the terms of the deal,
Right.
and more so give them comfort with us as a purchaser, in the sense that we were going to close the deal and our intentions were good. I'd say that was important as well.
Yeah, I'd say at the end of the day, the sophisticated investor that decides to actually take the time and meet, you know, those sellers will be the one getting the cake, right? Because these people often have been approached left and right, and as you so well said it, they need to be walked through the transaction, you know, from point A to point B.
I mean, it's a people business, right? And,
Right.
and it's a relationship business, and that necessarily involves two or multiple individuals trying to get along. And at the end of the day, in a transaction, you have a buyer and you have a seller. You can't necessarily look at it as a winner or a loser. The best transactions are when both parties feel happy to be going to the notary.
Right.
And if you can achieve that, then I think you have the recipe for a good transaction.
To go back to the initial plan, basically going over rentals, right? I want to know, where do you see opportunity in rental rates right now, and the rental market that we're in, given that, you know, post-pandemic, stabilization of rates, so on and so forth, you know, maybe shores, right? And people moving out of the city to work from home, or, you know, densification of, as we've seen distribution centers, we've seen more manufacturers go outside of the city, distribution centers getting closed because last mile delivery. Where do you see the rental rate being an opportunity right now in the market?
I mean, it's a great question because, you know, there's a slowdown in the market, right? So you're going to see maybe not downward pressure on rents, but definitely a stagnation of rents. At least that's what I am underwriting. So when I'm looking at a deal, I'm not necessarily underwriting 3%, 5% growth annually. I'm actually underwriting flat growth. I'm not underwriting a decrease, but I am underwriting flat growth. Now, where would I like to be? I think that you can't talk about, it's from an investor's perspective, you can't talk about rents without talking about the price you pay for the asset, right? So there's a little bit of both. The idea first and foremost is to buy at a price where my downside rent still gives me the yield that I desire, right? That's first and foremost.
Worst case scenario, right?
Worst case scenario, base case
Yeah.
scenario. You want to make sure that you're not stretching your rents, but more importantly, you want to make sure you're not stretching your purchase price.
Right.
Because your yield will be a function of both. Now, where am I most bullish on rents? I think that location is the determinant of rents, hands down. And so I would like to be on island. I would like to be on the west side of the island. I would like to be in Laval, and I would like to be in certain key markets in the South Shore, because I do feel like location is the main driver of what rents can be. You can't talk about rents without talking about everything else that goes on in a building, whether it's a small bay, a large bay, the clear heights, the loading, the zoning, etc. But I would say try to be in the best possible markets and try to pay a reasonable price where you can achieve your targeted yield. Easier said than done.
Something that we haven't mentioned in the, you know, in the previous conference panel, and is a question on my mind actually, is what's your turnover that you're willing to tolerate? Let's say you buy a property and the rent's not optimized and you're stuck with the tenant, right? How long will you tolerate, and how much will it affect your financing in terms of buying the property at a good price, right? Let's say you want to buy at a flat 7 cap, you're doing your prediction at a 7 or 7.5 cap, right? And you're trying to get there, but there's this tenant that published his lease at $5, right? And we know situations like these happen on the daily. So how do you deal with that, and how long will you tolerate that lease being in place for in the property, generally speaking? Let's say a one tenant property.
I mean, we have the benefit of having what I call patient capital, meaning that the investors understand that the returns we're trying to achieve aren't going to happen overnight. On an investment horizon, won't happen in the next 1 to 3 years. So in terms of how long are we willing to wait before a property can be optimized, I'd say that due to our patient capital, we can wait 2 to 3 years for a property, or we can be in a property for 2 to 3 years where there is zero cash on cash return. I.e., you're not making any money, you're not losing any money. The tenant that's paying an $8 rent is paying off basically all of your loan. What that also means is that your loan to value at purchase is probably going to be around 50%.
Right.
So the idea being that if you're buying a $10 million building, you'd have to put $5 million of equity
So
in.
you're freezing more cash.
You're freezing more cash, and you are generating a negative return if you think about the opportunity cost of the capital over perhaps a longer period of time, with the expectation that when that lease expires, you're going to be able to drive the revenue from $8 to $16, $17, refinance most of your money out, and then generate double-digit returns. So it's all a function of the capital you have. You know, we're investing other people's capital at Bayview, and so there has to be an understanding within the investor base of, are you willing to...
You have to be aligned.
You have to be aligned. Are you willing to not incur any cash flow for a certain period of time while you wait for a return of equity through a liquidity event, and then after that, a certain cash-on-cash return?
And the longer the wait time, the less of a risk of that option of optimization it has to be, and the higher return it has to be. Correct me, right?
For sure. I mean, if your money is locked in for 2 years versus 5 years, it's going to impact your IRR.
Right.
Let's talk IRR as, let's say, the metric we're looking at. You have to be sure of the stability of the optimization, but you also have to be, the price you pay will also determine your, the price you pay will determine your IRR just as much as how long it will take for you to get that optimization. So I'm paying less if I have to wait 5 years. I'm paying more if I have to wait 2 years.
You're buying on speculation at that point, right?
Yes.
And you're trying to make it beyond those rates.
Yeah.
Now, we briefly mentioned some cap rates, right? But what would be a cap rate of an optimized property you would feel confident of buying in a prime location for you at this point in Montreal? So where we're talking, West Island, Laval. Sorry to put you on the spot on this one, but I think that's something that people are interested in, knowing where the market is. And I always like to talk about optimized property, because a cap rate, a real market cap rate, is always lower than that, right? Because often properties are not fully optimized, right? You're getting into existing property, existing buildings, leases that might be at $5 a rent. You might be willing to pay more if you're able to bring that up to, the 5% cap. You can bring it up to 9, then you might be willing to pay the 5% cap.
Right.
But in an optimized property, just get the key, collect the check. What are you looking at in the market, and why?
We don't really look at that type of property. We are... As a private group, we are value add, so we want to create that value. We want to buy the unoptimized property and bring it to a certain level of optimization. I will answer your question though, if I did have to buy a property today and put debt on it as a function of where rates are today, first of all, it'll be a negative leverage right away, meaning that my the cost to service my debt will be higher than my going in yield. That's a given, because I'm not buying any properties today to 7.5 cap that are stabilized. So I think I'd be comfortable paying a 6 cap. I'll throw a number out there as being a 6 cap in a very strong market, because I know that when interest rates come down, I will be able to refinance and return a certain portion of my money. But I'd say, I would, as much as possible, avoid those types of transactions and be the buyer that's trying to create value.
Right. I've seen you do major paper value add, that I like to call them. So basically anything to do with financing, anything to do with leases, tenants in place. But I've seen you stir away from renovation value adds, if you can steer away from it, which I think is a very smart thing to do. Can you just explain to people that are maybe unsophisticated to industrial real estate the concept of short-term paper value adding and how it can benefit an investor, in that 1 to 1.5 year period? What's possible out there?
Is the question in terms of what you can do to bring a tenant to increase their rents without doing anything to the building?
Give me an elevator pitch of industrial investing value add.
I mean, the easiest example and the one that requires the least amount of work is a tenant paying $6 net where the market is $12 net. So let's say you can double the rent. If you can buy that property at a reasonable price, the simple strategy is wait till that tenant's lease comes to expiration and either negotiate with that tenant for that tenant to pay market rent. If that tenant does not want to, then the tenant will leave. You'll have an empty building. You'll work with a leasing broker and you'll bring that property to market to try to generate your $12.
Right.
So if I'm paying a 5 cap or a 4 cap based on the $6 rent, if I'm paying let's say if we're unsophisticated, we'll say if I'm paying a multiple as a purchase price, a multiple of the revenue that's being generated, and that revenue is a function of $6 rent, I'm going to be great I'll do very well if I can bring that rent up to $12. The difficult part in this market and most industrial markets in Canada is getting that property at a reasonable enough price where you can stabilize at a yield that you're satisfied with. I mean, that's the struggle, right? We all know that we can bring rents up because we know what market rents are, and we could have a buffer in our model, etc. But it's really getting that property that it remains the challenge.
It's mostly still mom and pop shop, right? And the buyers are not. The buyers are more and more sophisticated in industrial, especially in the last 2-3 years. You know, we've dealt with them. You have competition in this market as well. But what we see is these mom and pop shops, they want the price of that the guy sold for an optimized property, right? But they're still at $6, and the lease is published, and there's this and there's that, and there's potential contamination, and you don't know what that means, and there's no study being done. So, you know, we deal with that on the daily. Can you just speak a couple words about the importance of having maybe a good broker by your side that doesn't just do a service to the deal as, here you go, these are the papers that are required for this transaction, but actually underwrites the entire property from A to Z and gives you a plan of, okay, here's what we're going to do, here's where we're going, you know, how we can pivot, here's in that case, here's scenarios. Like, there's a difference there in this market, right? And a few people know about it. So
100%.
If you can speak a couple words on that.
Definitely. So I was saying in the conference that, you know, not all industrial is created equal. I'll also say that not all brokers are created equal. And to have a broker that, understands the market, I think that's baseline kind of what you would need in a broker, but more importantly, a broker that understands how to get a deal done, that has a bit of a business sense behind him, that is likable, personable, and that can speak to vendors maybe amicably and where they can gain their trust. That's where you have an edge as a broker. And I'll say that in our experience working together, I've seen that in you tenfold. Your ability to bring parties together, your ability to understand from an investor's perspective the price you need to pay to optimize an asset, and from representing a vendor perspective, giving them the comfort that the price they're receiving is truly market and that they are getting good value, that they're not getting screwed over. And just, you know, you have been incredibly personable in your approach, thoughtful in your approach, and
well, I'll just say thank you so much.
Yeah, of course.
I have a whole team behind me at PMML, allowing me to focus fully on the transaction itself. You know, I don't assemble the whole pie, and that's what makes us strong. You know, I can focus on what I'm really good at, which is getting the transaction done, no matter what. And we've had some curveballs. You know, we've had our fair share of curveballs,
100%,
and of personalities in transactions and everything. And at the end of the day, you got to sit down and accept the facts and manage the emotions around the deal, because they are there. You know, people tell me all the time, Anthony, there's no emotion in commercial real estate. I say that's
not true.
There's even more.
You're dealing with millions of dollars and, you know, assets being transferring hands. There's a ton of emotion on both sides. I mean, you know, one of the things that I struggle with all the time is the emotional part of the business. And it's a reality where you get excited about a potential deal, it doesn't pan out, maybe it comes back to life, you work for 3 months on a due diligence for the deal to fall apart at the last minute. I mean, these are, you know, as somebody that's trying to grow a business, when I see an opportunity and that opportunity falls apart, it's frustrating. So the emotion is everywhere. There's no doubt about it. And people look at this business from strictly a numbers perspective. And, you know, perhaps it's a tangent, but the biggest lesson I've learned so far in starting the fund is, you know, I understand the numbers well, but I didn't quite understand the emotional part of the business. And I think you could only truly understand it if you are in the game as a buyer, as an operator. And so same thing from the vendor's perspective. There is a ton of emotion when it comes to selling. There's no doubt. Yeah,
and I'd say I could see that with you, with your understanding of transactions, that you're going to go very, very far, because I deal with investors like yourself on the daily, and we see all sorts of investors, and your understanding of those emotions allow you to bring your expertise, whether it's on the legal side or on the financial side of a deal, to another level, right? Because what you're addressing is not the deal black and white as is on paper. You're addressing the person behind the deal and how to approach it on the black and white paper, you know, corresponding to that individual and their personality, and how to bring it to the next step, right?
Right.
So I'm going to finish this interview like this. Thank you so much for taking the time today. It's always a pleasure doing business, Cedric.
Thank you, Anthony.
And awesome panel today. I hope you enjoyed the rest of the day and the rest of the panel.
Thank you. Thanks so much.
All right.